bull market has produced a string of record high closings for U.S. equities, 10 in total, just in case you're keeping count. Our next guest says the ride higher is not over yet. Joining us from New York is JC Parets, founder of allstarcharts.com. JC, thanks so much for joining us.
Yeah, thank you for having me.
Well, we need something to break out here. I think now it's been 33 consecutive trading days where we haven't had a meaningful move on either side of 1%. Take us through your thinking as to why, A, we're going to get a breakout, and B, it's going to be higher.
Yeah, well, I mean, remember, it's August, right? So as investors, we need to recognize the type of market environment that we're in. And you know, it's just what it is. The big boys are on vacation with their families and, you know, at the beach and playing golf with their buddies. And the rookies are at the desks. And, you know, you're seeing less volume, obviously, less liquidity out there, and not a lot of volatility. And, you know, that's fine for the current environment that we're in. Come after Labor Day, expect volatility to pick up. That's just normal seasonal tendencies. But as far as price itself is concerned, I think we kind of need to take a step back and recognize the fact that the S&P 500 essentially went nowhere, let's just, for argument's sake, call it 14, 15 months, really since May of last year, and then that consolidation resolved to the upside. So we have to respect that. And, you know, as the old saying goes, the bigger the base, the higher in space, right? So based on my calculations, I think we're going to 2350 in the S&P 500. That represents another 6-7% to the upside, and I think it happens. I think it happens in the fall. And as far as risk management is concerned, which in my opinion is the most important thing, we still only want to be long the S&P 500 if we're above last year's highs. I think it's that simple.
All right, well, let's take a look at the three sectors that are going to take us there. By your estimation, it's the technology sector, it's the transports, as well as those financials. Now, tech has certainly shown some leadership from the February lows. Let's focus in on the XLK, for example. From a technical perspective, what are you seeing that gives you some confidence that that's going to be a sector that continues to move higher?
Sure, and in a similar situation to the S&P 500, where we essentially peaked in the second quarter last year in technology, essentially went nowhere to sideways over the next 14, 15 months, and then like the S&P 500 resolved higher. And that makes a lot of sense because remember that technology by market cap is by far and away the largest sector in the U.S. stock market, represents 21% of the S&P 500. So we're talking monster market caps and names like Microsoft and Apple and Facebook, and we can go on and on. I mean, these are massive market caps. I mean, just Apple and Microsoft alone, we're talking almost $1 trillion in market capitalization. So the fact that Microsoft is pressing up against the all-time highs from late in 99, Apple's is now breaking out. I think Apple heads up towards 130. You know, those big cap names are driving tech. And I think it makes sense that the S&P 500 goes higher as well, considering, you know, how massive these companies are that, you know, drives a cap-weighted index, as is the S&Ps.
So tech has obviously seen a breakout. When you take a look at the Dow transports, for example, there seems to be a lid that's been placed on their upside potential. Within the transports, trains, planes, what do you think is going to be the deciding factor that breaks us higher?
You know, the recent outperformance out of transports that we've seen, you know, in the stabilization in the relative strength as far in the last month, and now we're starting to see it outperform, I think that's here to stay. And let's rewind a little bit. Let's remember that the transports peaked at the end of 2014 in the fourth quarter, 6 months before the S&P 500. So it was warning that that we had issues, right? And then this January, transports bottomed the month before the S&P 500. So once again, was showing that leadership, in this case, a bullish leadership, right? And I think the outperformance continues. And then when you break it down, you talk about, you know, planes and trains and whatnot. I like the railroads. The railroads have built a nice little base. We're now breaking out. Look at a name like Canadian Pacific, looks great. And I think that if the transports continue to outperform, and I do believe they will, you know, that's another tailwind for equity bulls.
Let's also end here with financials. A lot is riding on that, especially going into tomorrow. Janet Yellen speaking. Now, that's a fundamental. I know you don't want to look at that, but what's the setup going into a catalyst like that and for the rest of the year?
You know, Janet Yellen speaking is not a catalyst. I mean, she doesn't stop talking, right? So if we are constantly focusing on what some lady may or may not say or what she might be thinking, you know, as far as I'm concerned, that's a huge waste of time. That's a, you know, time suck, right? So I think that what we really need to focus is what we're seeing in the actual price action of financials. Remember that this has been the worst sector in the world, for that matter, if you include European banks, right? So the fact that they have stabilized and stopped crashing, and now we're seeing them outperform with interest rates rising, I think that's huge, because we talk about tech as the most important sector in America based on market cap, but in reality of the matter is financials. We've never had a bull market without participation of the banks. So the fact that we're seeing that is great. And when you ask me what's going to drive financials higher, look no further than its largest component of the XLF is Berkshire Hathaway. We're talking about a monster $250 billion company breaking out to new highs. I think Berkshire Hathaway has another 10% to the upside. That's going to drive financials higher, interest rates higher, and I think that's good for the overall market.
As a technician, how do you deal with an index change? The financials, about $605 billion is going to come out of that index when the REITs separate in mid-September and create their own index. Is that going to affect the picture that you're seeing, because there has been such a hunt for yield and it's been going into REITs, which has been tucked under the financials?
I'm sorry, I didn't catch that. Who's creating a new index?
The REITs. The REITs will no longer be part of the financials index.
Oh, the REITs, right.
Real estate investment trusts.
Got it. Yeah, I mean, when you look at an XLF, there are a lot of REITs. But then look at a BKX, for example, which is the U.S. Bank Index, which is much more of a pure play. It really moves with XLF. So, you know, regardless of whether they're taking out the REITs of that particular index, take a look at another one. You know, look at BKX or look at KRE, which is more of a regional bank index, and you're seeing similar strength there as well, very highly correlated. So if they're taking REITs out, you know, fine. It might be less of a, you know, it'll probably be a tailwind for that particular index, because there's less of a reason to own that for dividend yields. As interest rates are going up and REITs get hurt, I think XLF will benefit by REITs being taken out of there. So I would look at that as a tailwind for sure.
Okay, so those are the three sectors you like: tech, transports, financials. Let's close this conversation and open up a bit of a wild card and end on a bold call. The pound, you like it as a bull?
You know, it's hard not to. You know, sentiment is obviously some of the most bearish that we've ever seen, and our data goes back 25 years. Look at the commercial hedgers, right? We look at the commitment of traders report that comes out every Friday, and this is the smart money, quote unquote, right? And they are the longest in British pounds that they've ever been in history. So sentiment is bad, the smart money's buying, and I think if we're above 135 in British pounds versus the US dollar, I think we're going to get a monster squeeze. You know, everybody's caught on the wrong side, in my opinion, and it's not just like, oh, JC came up with this like fantastic chart that says pounds are going up. It's not like that. Take a look at the pounds versus yen. Looks great. Take a look at euro pounds, right? That peaked at key resistance. So that's rolling over, bullish for pounds. So when you take the weight of the evidence, you look at sentiment, you look at the pound versus all of the currencies, I got to tell you, it's hard to be bearish. So, you know, I think we shoot through 140. I think we could be long above last week's lows all day.
All right, JC, we will leave it there. Thanks so much for bringing all of your ideas and charts to us.